What if the real secret to building wealth was not complicated strategies, constant trading, or trying to outsmart the market, but something far simpler? What if the smartest investment strategy was not about prediction or timing, but patience and discipline? And what if almost everything the financial industry tells you is designed to benefit them, not you? This is the core message of the Little Book of Common Sense Investing by John C. Bogle, the founder of Vanguard and the creator of the first index fund. Bogle changed investing forever by exposing a truth that many professionals hoped would never be widely understood. Most investors lose money not because markets fail, but because they try to beat them. The Little Book of Common Sense Investing explains that the stock market as a whole is an incredible machine for building wealth. Over the long run, it consistently grows as companies innovate, economies expand, and productivity increases. If you simply own a broad slice of the entire market and hold it for many years, you benefit from this natural upward force. But the moment you try to pick individual winners, time the market, or pay high fees to experts, you dramatically reduce your returns. Bogle famously said, "Do not look for the needle in the haystack. Just buy the haystack." In other words, instead of trying to guess which stocks will outperform, buy all of them at once through low-cost index funds. One of the most important lessons in the book is the difference between investment return and investor return. Investment return is the actual performance of the stock market itself. Historically, the stock market has delivered a long-term average return of around 9 to 10% per year. But the average investor earns far less than that. Why? Because they constantly buy and sell, react emotionally to news, chase hype, and jump in and out instead of staying invested. Bogle explains that investors destroy their own returns through impatience, fear, and overconfidence. If they simply did nothing most years, they would earn far more. Another key message is that costs matter. Every time an investor pays fees to brokers, fund managers, or trading platforms, those fees reduce returns. A 1% fee may sound small, but over 30 years it can cut total returns almost in half. Time causes money to grow, but it also causes costs to grow. Bogle argues that the biggest obstacle to wealth is not market performance, but unnecessary expenses. The more Wall Street takes, the less you keep. Index funds have extremely low costs because they do not try to beat the market. They simply match it. Because of this simplicity, they outperform most actively managed funds over time. Bogle demonstrates this using decades of research. Over long periods, more than 90% of actively managed funds fail to beat the market. The few that do cannot be identified ahead of time. Some funds outperform for a short period and then collapse. Some become popular and perform poorly afterward. Success is random, temporary, and unpredictable. Betting on active managers is like gambling. You might get lucky once, but odds are against you. Index investing, on the other hand, guarantees you earn the market return, which historically has been excellent. Bogle writes, "When you own the market, you win. When you try to beat it, you lose." Another major concept in the book is the power of compounding. Small differences in returns compound into massive differences over time. Imagine investing $10,000 at a 7% return. In 30 years, it becomes $76,000. But at 10%, it becomes $174,000. A difference of only 3% nearly doubles total wealth. Bogle teaches that the fastest way to improve returns is not through risky speculation, but through reducing fees, avoiding losses, and staying invested long term. Time is the most powerful force in finance. Bogle also addresses human behavior and the emotional traps that destroy wealth. When the market goes up, investors feel confident and buy aggressively. When the market falls, they panic and sell. This cycle causes them to buy high and sell low. Bogle calls this the tyranny of emotion. The best investors are logical and calm, not reactive. They understand that market declines are temporary and normal. Every crash in history has eventually been followed by recovery and new highs. If you stay invested, you benefit. If you panic, you lose. Bogle encourages investors to view volatility as opportunity, not danger. Another important idea is the relationship between investing and speculation. Investing means owning businesses for their long-term performance. Speculation means betting on price movements and short-term trends. Speculation is exciting, dramatic, and addicting. Investing is boring, stable, and patient. Most people choose excitement over success. Bogle reminds us, if you want excitement, take 8% of your portfolio and go to Las Vegas. Otherwise, stay disciplined. One of Bogle's strongest arguments is that capitalism works because businesses grow, innovate, and produce value. When you invest in the total market, you become a part owner of thousands of companies. As those companies succeed, you succeed. You profit from human progress. You do not need perfect timing, special knowledge, or predictions. You need commitment and time. Bogle believes that investing should serve the investor, not the financial industry. Index funds democratize wealth creation. So what is Bogle's simple strategy? Invest in a low-cost total market index fund. Contribute consistently. Hold for decades. Ignore the noise. Ignore predictions. Ignore fear. Ignore greed. Trust the long term. It may feel slow, but slow is fast. Most overnight success stories come from decades of compound growth. Bogle warns that the greatest enemy of financial success is the illusion of control. People believe they can predict the future, but no one can. Wall Street experts are constantly wrong. Economists fail to forecast recessions. Investors chase trends only after they peak. Bogle encourages humility. He says, the stock market is a giant distraction from the business of investing. Focus on businesses, not price movements. Focus on principles, not predictions. The Little Book of Common Sense Investing also challenges the myth that investing must be complicated. Many people avoid investing because they believe it requires advanced knowledge. But complexity benefits financial institutions, not individuals. Bogle proves that the simplest strategy is the most effective strategy. Common sense beats sophistication. Patience beats intelligence. Consistency beats genius. The final message of the book is about financial independence. You do not need luck or extraordinary talent. You need discipline. Wealth is not built in dramatic movements. It is built quietly, slowly, invisibly, through small, repeated decisions that compound over time. The best investors are not the smartest. They are the calmest. So what can you apply starting today? First, stop trying to predict the future. Second, invest consistently in broad market index funds. Third, avoid high fees and frequent trading. Fourth, stay invested through market highs and lows. Fifth, be patient. Time rewards those who wait. Once you understand that investing is not a game of speed, but a game of endurance, everything changes. The big takeaway from the Little Book of Common Sense Investing is this. The simplest strategy is the smartest one. You do not need to beat the market. You only need to join it. When you stop trying to win quickly, you win big over time. Bogle built an entire investment revolution on one principle. Stand still, and you will beat the people who are rushing in every direction. That was The Little Book of Common Sense Investing by John C. Bogle, broken down into its most important ideas and lessons. Which principle stands out most to you? Staying patient, reducing costs, avoiding emotional decisions, or investing in what you understand? Share your thoughts in the comments. And if you enjoyed this summary, make sure to like this video, subscribe to 10-Minute Books, and tap the bell so you never miss our weekly deep dives into life-changing books. Remember, slow is smooth, smooth is fast, and wealth is built in silence.